Ira, you get these calls of price lower, yield higher, and then you get blowout 10-year auctions. And in Japan, you try telling them not to love a 10-year at a 125. What do you make then of that auction and a 125 and the path higher?
Yeah, so we actually just about half an hour ago, we received the allotment data from that 10-year refunding auction, which was absolutely stellar. I mean, it was one of the best auctions that I've seen in my 25-year career. So, and when you look at the details of who actually did the buying, it wound up being foreigners were the big jump. So they had only purchased about 24% of the May 10-year note. This past month, they purchased 37%. So that's a very big jump in a single month. So it can almost the strength can almost all be attributable to foreigners. Domestic investment funds still are big buyers of U.S. debt, though, because there's still a lot of people pumping money. We still have a pretty high savings rate, so some of that money is going to find its way into the Treasury market. So domestic investment funds even bought about half of that auction, which was pretty much average of what they've been buying.
I am curious about some of the psychology behind this Burry trade, at least as being reported by Bloomberg, because this seems to be not just a bet here on what direction prices and yields go, but really sort of a fundamental breakdown of, I guess, how the Treasury market has been traded, how it has been bought now for really more than a decade.
Well, I think when you look at certainly when you look at history, we're near historically low levels, right? Like there's no doubt about that. I think that if you're going to sell treasuries here in a very major way, and if you think that this is like the Big Short, where we're going to see treasury prices, in the 30-year, for example, go down 30 or 40%, it's not out of the question. There's certainly a tail risk that can happen, but in order for that to happen, you either need to have one of two things occur. Either one, we need to get rid of all of the risk off environment that we have, and that doesn't seem very likely. Or you wind up having a massive buyer strike because there's, basically people don't want to buy all of the treasuries that the government's going to be auctioning over the next couple of years. Traditionally, that's not the case because treasuries are still considered the safest asset in the world. And like Taylor noted in the beginning, when you have interest rates in a lot of other jurisdictions that are negative, maybe a 1.5% or 2% 10-year treasury yield is going to get bought because it just seems so attractive. So our view is that yes, treasury yields will probably be higher at the end of the year and at the end of 2022, but reaching 2%, we think that might be a little bit of a line in the sand where you wind up seeing foreigners and others just come in droves and wind up buying a lot of bonds at those kind of yield levels.
Basically, Tina spilling into bonds. There's no alternative when it comes to the bond market as well as in the equity market, Ira. Just push us ahead this week, a virtual Jackson Hole all over again. Which way do you think the yield, how's the bond market going to get buffeted, do you think? Do you generally expect a more dovish tone than perhaps we previously thought?
So actually what I think that Jay Powell is going to do is two things. One is he will be dovish. I think he'll continue to say that there's a lot of risk to the economy. They haven't reached the full potential. The employment situation is not perfect yet. But on the other hand, he's going to, I think, continue to hint, as the minutes from the July meeting did, that they are going to reduce asset purchases. And one of the big reasons for that is not that we're out of the woods. And I think he's going to couch this as what I'm calling a dovish taper, where he'll basically say, look, we're going to keep interest rates very low at the front end until we see basically a roaring economy and super high inflation and things like that. Super high is not relative to the 70s, but relative to recent history. But I think that they want to taper because they realize there's so much cash in the system, and they might actually be hurting the money market and the funding space, the very short-term part of the market, more than they're helping right now. And the reverse repo facility, over $1.1 trillion in usage, just shows that they're buying a bond and investors and banks are just putting it right back to the Fed in the reverse repo facility. What's the point in buying any more bonds at this point?